Good morning. I'm Lou Spellman. We are taping today an interview with Dr. Lacy Hunt for the Spellman Report. And Dr. Hunt, this is the third time we've got you back on the hot seat.
Yes.
We very much appreciate your taking the time to join us today. Lacy is an economist, a PhD economist with Fed experience, with a major international bank. And currently he is the intellectual compass for the investment team at Hoisington Management here in Austin, Texas. Hoisington is the manager of Wasatch Hoisington U.S. Treasury Fund, which is an institutional fixed income fund. And these are very exciting times indeed for someone in your position. In fact, these are incredibly historic times in terms of the economy, in terms of financial markets, in terms of policy, in terms of how to deal with the most important variable, I believe, in your understanding, and that is the issue of debt, the accumulation of debt, which is what is dominating the scene and affecting anything economic and financial. Could you give us before we get to that, I just want to point out that Lacy has done an extraordinary interview with Wellington at Whedon, and it will be included on this video that you can click onto, which I very highly recommend you do read. But the issue has to do with the debt overload. And in that regard, would you walk us through your thoughts on the issue of the U.S. government debt, U.S. debt overload, not just U.S. government, but the entire palette of debt in front of us?
Well, our total debt, public and private, is about 360% of GDP. So we have 53 trillion or so of debt. We only have 15 trillion of GDP. The debt levels are a little lower than they were a couple of years ago, but they are virtually unprecedented except for that period of time. This is the fourth major period of extreme over-indebtedness that the country has experienced. The first was in the 1820s and 1830s when we were building up the canal and steamship and the turnpike debt. That produced a very prolonged period of economic weakness that lasted really until the American Civil War. The second period was the buildup of railroad debt in the 1860s and the industries that fed the railroad boom. This led to a great deal of angst in the U.S. economy. All the transcontinental railroads that were government funded failed. Some of them failed many times. And then the third period was the 1920s. Most of the debt was fueled by unwise monetary policies, led to speculation in stocks, real estate, other unproductive uses. And now we have the current period, which is a much greater level of indebtedness than any of those. And
which, if I can point out, we could see the comparison of today as compared to the peak debt load in 1933.
I think I would say the more relevant point is 28, because the reason the debt to GDP ratio surged after 28 was the fall in the denominator. But what's interesting is that from the 1875 peak, we don't go above it until 1916. In other words, it takes a long time for the economy to absorb and operate with such a high level of debt. We don't go above the 33 peak until this century. I mean, these debt elements become controlling. The main theory here comes from Irving Fisher. And when the debt buildup was occurring in the 20s, he didn't realize the implications of it. In fact, he didn't see the Great Depression coming. And it was only afterwards that he went back and looked at the data, and he came to the conclusion that the normal business cycle model, where you have a couple of bad years and then you have 5 or 6 good years, and then the bad years are relatively short, and then you go on and you have this normal cycle. But when we become extremely over-indebted, according to Fisher, it mutes the business cycle. and you don't get the full-fledged development. And more importantly, if you try to solve the indebtedness problem by taking on more debt, then you buy yourself some transitory gains at the expense of making the economy weaker. And unfortunately, we're trying to, so far, to cure an indebtedness problem with more debt, not only in the United States, but in Europe. If you look at the next chart, in the Eurozone, the 17 countries that are part of the currency, the debt there is on the order of 68 trillion US dollar equivalent. And they only have 14 trillion of GDP. So their debt to GDP ratio is 100 points higher. And all of their solutions are to find some type of bridge financing. In other words, one more layer of debt on the existing layers of debt. And so the bridge financings temporarily calm the system down, but in the final analysis, the debt has to be paid. And the over-indebtedness saps the strength of the area, and so the debt crises are just merely pushed down the road. In the UK, indebtedness is at 450% of GDP, 100 points higher than in the US. People think the situation in Canada is better, and the government debt level there is considerably less, but private indebtedness is greater in Canada than it is in the US. And so the total Canadian debt is about 70 percentage points greater than the US. The worst situation in the world is Japan. In 2011, their total debt is 500% of GDP. When the debt crisis started in 1990, it was 400. So they've added 100 percentage points of debt to GDP in 21, 22 years, thinking that more debt was the solution. Yet the level of GDP in nominal yen today is unchanged from 20 years ago. The government debt has gone from 50% of GDP, and the preliminary figure for 2012 is 230. It's almost gone up 5 times. And so the quagmire in Japan persists, trying to solve an indebtedness problem with more debt. And it really is counterproductive.
Yeah. Well, so it's not only the U.S. problem, it's a worldwide problem, and it dwarfs previous episodes. And there's another, and Fisher's views correctly, certainly followed our past experiences. The overload of debt out of an income stream slows the rate of spending and hence income generation, and we end up with deflation. So this is the Fisher deflationary depression that follows typically that situation, and those are the forces that are pulling us down and dominating us. But I think one thing that I'd like to point out that doesn't show up on this graph, but in your last quarterly letter, is that these are the existing debt levels, and but our unfunded liabilities going forward are some great multiple of this.
They are indeed.
The number you came up with, which I thought was astonishing, well, one number that's fairly well known is the unfunded present value of the U.S. government entitlement programs is about 59 trillion as compared to the existing 15 trillion, so it's another 4 times. But on top of that, you came up with a number of 200 trillion of all unfunded future obligations of the U.S. government.
And the state and locals and the pension
And the state
plan.
and local added into
In other
that.
words, a comprehensive figure. This number was generated by Dr. Lawrence Kotlikoff at Boston University, who is perhaps our leading researcher in this area. And but even at 59 trillion, we're talking 4 times GDP.
Right.
Amazing degree. We don't have comparable numbers for Europe, but what numbers we do have indicate the situation there is even worse. The European Central Bank funded a study at Freiburg University, and it was completed in early '06, which was before the Depression, or the Great Recession, which of course has made the conditions worse. And for the 19 countries out of the 27 that are members of the European Union, they found that the unfunded liabilities are 5 times GDP. And this was in '06.
Right.
So the Europeans, who have worse demographics, have made promises that are even more lavish than we have. have an indebtedness problem that's even greater than our own.
Yeah. There's one other question I'd like to ask regarding the heavy weight of the debt. Quantitatively, it's quite large, but it strikes me, or this is a question rather than my conclusion, since the previous examples that Fisher looked at was basically the ratio of private debt, particularly corporate debt, to GDP, which, and in our case, it's the consumer and the government. So these are accumulations of debt which really is bringing forward future consumption, and it did not generate any capital equipment and factory and plant to generate output and jobs. Mm-hmm. So it strikes me that this type of debt, this profile of debt, weighs much more heavily on the economy than if it were corporate debt.
I think your point is well taken, and I think some of the leading researchers are trying to address that very issue. Mm-hmm. There's a very eminent researcher by the name of Stephen Giacchetti, for many years director of research at the New York Fed, Cal Berkeley PhD. He's now economic advisor to the Bank for International Settlements. In a paper that he gave at Jackson Hole last summer, same time Bernanke was speaking, or shortly after Bernanke was speaking. It's called The Real Effects of Debt. And what Giacchetti and his two BIS colleagues did was to identify the point at which government debt to GDP, then corporate debt to GDP, and then household debt to GDP become counterproductive. Debt used in moderation, in other words, the normal bank lending, that's a good thing. That facilitates economic activity. It's only when the debt levels become excessively high. And Giacchetti uses an interesting term. He uses a medical term. And he identified econometrically the points at which the debt to GDP ratios in the individual sectors become cancerous. And the problem that we're facing is that in the US and in Europe, we're beyond those levels, and we're trying to push them higher.
All right. In a situation, what we clearly have is a situation where the stock of debt relative to the flow of income to support that debt is out of equilibrium. It's not sustainable.
I like the use of that term. To my way of thinking, we're in a debt disequilibrium.
Right.
And it's been going on, and it's persisting. We're not in an equilibrium situation.
Right.
We have too much debt, and we're not resolving the matter.
Right. Well, the question is, what are the market? There are two ways it can be addressed. One is the market will address it in various ways, and policymakers will attempt to address it. So let's run through the market corrections of the out of equilibrium first, and then run through the various options that the policymakers have.
Well, to my way of thinking, there's really only one path out, and that's a path that no one wants to hear, and that is austerity.
Austerity from paying it off, or,
in other words,
or from default?
You can go through default, mm-hmm. and then people will deny you future borrowing. Or you can actually do the belt tightening yourself, and in some cases the austerity is imposed upon you. But if you look at the study from the McKinsey Global Institute, they found four paths out. But 75% of the cases involve austerity, mm-hmm. either self-decided or imposed austerity. The people say, well, haven't wars gotten us out in some cases? Well, yes, they have. And casually, you could make the case that World War II allowed us to pay down the debt. But I think that is a very superficial and a type of analysis and basically incorrect.
But it also only includes U.S. government debt. But I noticed in 1950, the overall debt to income rate to GDP ratio was not nowhere near the high.
No, it had come off very dramatically.
Had come off dramatically in the Depression.
And the reason that it came off is that when we joined the war effort, we had a tremendous surge in our exports. Our allies were in the midst of war zones, and they had manpower shortages.
Right.
And so we were able to export to them anything we could produce, whether it was raw commodities or consumer goods or military goods. But our people could not spend the money. We had mandatory rationing. And so people got their paychecks from the export gains, and they either bought savings bonds or other short-term assets, paid down the debt. The saving rate in World War II got up to 25%. And so by the time World War II was over, the high total debt to GDP ratio had been brought down to a very reasonable level, and we were able to then resume a normal type of economic activity. But austerity is the only viable path out. So government wants to help, monetary policy wants to help. The Federal Reserve takes actions to try to encourage the banks to make more loans. The government runs larger budget deficits. But all of these entail further increases in debt.
Yeah.
And so the monetary policy and fiscal policy efforts have only a tiny short-term positive impact, and then they get swamped by the fact that the debt levels continue to rise.
Well, if we take them in turn, the fiscal, you made a wonderful point in your December newsletter, which was that the GDP multiplier essentially is zero or negative, which basically says if you try to support the economy, you get no bang for the buck in terms of supporting the economy, and you add to debt. So basically, it's not even a trade-off. It's you're going backwards.
Yeah, you are.
You're going backwards. You're buying time.
Yeah.
Now,
well, the studies show that if you increase deficit spending, you can stimulate GDP for 3 to 5 quarters, depending on the initial conditions. But at the end of 5 quarters, you start if you start with 15 trillion, at the end of 5 quarters, you start rolling back, and at the end of 3 years, depending on the initial conditions, you end up at 15 trillion. Except you have a larger share of economic activity in the government hands, and a reduced share in the private sector. And the private sector has got to generate the resources to cover the higher indebtedness.
But it's politically appealing because it might get you through the next election.
That's correct.
All right, let's look at the monetary policy options. The Fed very clearly, for a number of reasons, has moved to a policy announced at its previous meeting, not this last, but about a month ago, which is they're going to seek to keep interest rates as low as they can and for the first time ever announced a positive inflation target of 2%. So you have two elements to this policy: low nominal rates, hopefully lower than the inflation rate, so that you have a negative real interest carry to help carry the debt. They're doing their share of the work, which also happens to correspond to their views on what's needed for the economy. So it was quite easy for them to do this. But the question is, can this possibly be effective? So there are really two issues: can they keep the long rates low, and can they keep the inflation rate at 2%? Because the impact of all this debt overhang is a slow economy and deflationary forces. So let's take them one at a time. Can they keep the interest rates low?
If the interest rates stay low, in my opinion, it will not be a result of Federal Reserve policy. It will be a result of the debilitating effects of the debt. And I think what the Federal Reserve does is largely impotent. I don't think the impact is great. There is a short-term effect, which I think is quite negative, and I have a chart that sort of deals with that. The Fed now has engaged in 3 different balance sheet expansions. The first was QE1, in which they expanded the balance sheet about $1.5 trillion. And Then they had quantitative 2, which they expanded the balance sheet $600 billion. And in actuality, we've now had a stealth easing, a third. It's not as large, but to help the European Central Bank, they expanded their balance sheet from early December to its high by about $105 billion. Whenever they expand the balance sheet over the short term, there appears to be what I would call a market effect. And we can see it from this research that I've done here. When the Fed injects the liquidity into the marketplace, there is a response in the equity markets domestically and globally, and also a response in the commodity markets. The Fed is giving the potential speculators more reserves, or margin balances, if you will, at a zero cost. And they can't control how that's used after they inject it into the system. And so we can see in all 3 cases, when they expanded the balance sheet, there was a gain in the stock market. But the gains proved to be transitory. To my way of thinking, Lou, any market, whether it's equities or commodities, there's a fundamental demand curve and a fundamental supply curve. One of the things that can shift the demand curve is liquidity. So they come in, they inject the liquidity, but the liquidity may have intended and unintended consequences. And one of the unintended consequences is that when they have done that, some of the commodity prices, particularly gasoline, some of the critical foodstuffs, have risen in percentage terms even more than stock prices. Now, I don't mean to say that the Fed caused all of it, because these are complex markets, a lot of things going on. But when they raise the inflation rate, that makes millions of our modest and moderate income households worse off.
Yes.
Because the wages do not rise.
Right.
That's beyond the Fed's control. And so they induce transitory inflation in QE1, QE2, and now in this stealth easing. And what's happening? Real wage income is declining. And so the only way that the mechanism that they would generate a sustained inflation would be if somehow you would have a money price wage spiral. And by money, I'm not just talking about the stock of money, but the velocity of money. In other words, the whole monetary complex. And then that generates higher prices, and then the higher prices lead to higher wages, and then it's validated by a further expansion of money and velocity. Well, they can expand the balance sheet. That gets a transitory increase in inflation, but there's still too much labor, domestically and internationally. The wages, since quantitative 1, have actually been slowing.
Right.
In the month of February, average hourly earnings only rising 1.1%. And for the last 12 months, only about 1.8%. The inflation rate is up close to 3%. So that puts our middle income households in worse shape. And so immediately, the Fed's desire to make things better, help the European Central Bank out, try to bring the interest rates down, they set off a chain of unintended consequences.
Which is exactly as you wrote about at the end of QE2 last June, the last time we spoke, which is they reduced the real wage of the working the workers.
And they do it around the world.
Yes.
And the thing about it is, the lower the income levels, the greater percentage of the budget goes to food and fuel. So if the Fed takes policies that raise commodity inflation, the effects outside the United States, where income levels are lower than in the United States, are even greater. And so you tend to reduce real wages outside the U.S. faster than you reduce them in the United States, which then means that we're still hung with this large trade deficit.
Yes. So basically what you're saying is the Fed is unable to really, and they've come to realize after QE2, and they're beginning to now realize it once again, that their balance sheet expansion has generated lower real wages. and a higher inflation rate, which causes them to back off. They've learned the lesson twice. So
Well, they're learning it a third time. At some point in time, the learning curve needs to kick in.
yes. Well, the other thought I had in terms of whether or not the Fed's ability to sustain the debt load with a low interest carry cost based on low nominal rates, and in other words, a negative real interest rate carry cost for the government. There's another problem that they have. Not only do they lower real income and real wages, but by the Fed attempting to go into the market and purchase treasuries at a price above market, basically at the point when they stop purchasing those treasuries, the price settles back down, and then they have systematically set up a mechanism where they then have capital losses on their balance sheet. And they too, similar to the European Central Bank, have very thin net worth. They're at about 2% net worth. So it seems conceivable to me that their Operation Twist going into the long-term area has set them up such that once they stop buying, they could go insolvent, which then could lead, certainly not a shutdown of the central bank, it would lead to subsidies by the government to recapitalize them, but it could lead to a flight on the dollar. So I think the Fed has backed themselves into a corner.
Well, the Fed, I don't think the Fed knows how they would exit their holdings. And they've got a balance sheet now that's $3 trillion. They have less than $100 billion of capital, which is it's a giant hedge fund, let's face it. The European Central Bank is an even larger hedge fund. They have $4 trillion balance sheet, US dollar equivalent. They have less than $100 billion US dollar in capital, so they're even more thinly capitalized. They're also probably on average holding a much lower quality credit than the US Federal Reserve. My point of concern for Fed policy is what some people refer to as the Cochrane constraint for John Cochrane at the University of Chicago, which is very similar to what Reinhardt and Rogoff talk about, the bang point. And it's lurking out there. I don't think these points are immediate, but this is the fundamental concern. Let me explain what we're talking about. In the first 5 months of the current fiscal year, for every dollar the U.S. Treasury spent, we had 58 cents in tax revenues and we had 42 cents of borrowing. Some of the European countries that are in real serious trouble are trying, those ratios are the opposite. In other words, they're trying to borrow 60, 65, 70, or even more % of their budget, and their tax revenues are 40% or less. Their economic history has taught us that there is a point at which the markets say no mas. In other words, we don't have the confidence that you can repay us. John Cochrane did something that I thought was very interesting. He said, how do you view the value of an asset? Well, one thing to do is to look at the stream of earnings of that asset and discount it by the appropriate discount factor. And you convert it in net present value terms. Well, let's do that for treasuries. Treasuries have got to be equal to the discounted value of future government surpluses. In other words, the reason people are lending the money is that they expect at some point in time that the proceeds are going to be repaid. Well, if the marketplace loses confidence in that future stream of budget surpluses, then the variable that moves is the discount rate.
So what discount rate balances both sides of that equation?
That's correct.
What size is it?
And at that point in time, then monetary policy is inoperative.
Right.
There's nothing that monetary policy can do.
Right.
And if they were to belatedly assume that they are going to be able to increase the balance sheet further at that point in time, it would be counterproductive. It would only lead to a greater realization of the improbability of the debt repayment. And so from the standpoint of the longer term issues that we're facing, the best thing, in my opinion, and my opinion doesn't count, is for the Fed not to do anything, to try to let the marketplace make these adjustments.
Yeah, you've made a very, very interesting and important point, and that is our central bank and the European Central Bank even more have become the buyers of the shaky, risky assets, as you call it, a hedge fund, whereas our commercial banks are trying to get less risky. Mm-hmm. And so we have now the official banks being the risk lenders in the system and within capital. Mm-hmm. And we know where that ultimately leads, and it's not pretty.
No. And unfortunately, there are other unintended consequences of this type of policy, in that the people that played by the rules and conducted themselves in a prudent financial manner and saved are being severely penalized by the low interest rate structure, so that those who have engaged in bad behavior can be bailed out. And the system produces a great many inequities. And another tragedy of the current system, and one that I think that the economics profession does not understand, is that the reason that we're in this predicament is that the Fed and the European central banks failed to do their job in the early part of this decade and in the last part of the 20th century. Monetary and fiscal policy, both the Friedmanite view, the Keynesian view, is that the way you deal with a major contraction is by the correct monetary and fiscal response. And if you're dealing with a mid-range cyclical type of economic downturn, I think that is probably correct. But when the downturn reflects extreme over-indebtedness, it really doesn't matter that much what the monetary and fiscal response is. The way you keep the economy sound is that you prevent the buildup of debt in the first place. Now, Bernanke sided with Friedman, and he felt that he could always contain the problem. And the Keynesians have always felt that if there were a problem, they could contain it with fiscal policy. What I am saying, and I make them both mad here, is that neither view is correct. That Walter Bagot, who was one of the early great students of the central banking, he said the critical role of the Fed is to be a lender of first resort. But I would modify that and say that the central bank has to be the preventer of first resort. The problem is that when you're in the overtrading phase, as Kendall Berg described it, when things are rollicking along and the debt is producing asset price gains and employment gains and everybody's enjoying it, there's no one that's going to step in and do the job. So the Federal Reserve needed to have been using its knowledge of the Great Depression from 1998 through 2006, but they were silent. There were some individual voices, just as there were individual voices in the 1920s, but they were drowned out. And so once you create the over-indebtedness, then your path is basically locked in, and the monetary and fiscal response doesn't really matter. In fact, it makes it worse if you try to build one layer of debt on the already high levels of debt.
My first boss, William McChesney Martin, famously, as you could finish my line.
Yeah, I know. But see, William McChesney Martin had lived through that experience.
That's correct.
And he knew that.
And the famous line was, as Fed chairman, you're appointed to take away the punch bowl once the party really gets going.
Yeah, that's correct.
And we could.
No one was willing to take away the punch bowl.
Right. Okay, I have a few other wild card questions. What ifs?
So we just make one other point.
Sure.
And apparently in those type of situations, when you're in the wild over trading phase of Kindleberger, in which that's in the term that's in Smith's Wealth of Nations, the classical economy, there's no one that's going to step in.
Right.
In a mildly out of hand party, like we had a few episodes in the 50s, 60s, and 70s, there are people to step in. But
what the point Lacy is making in general is that our system is prone to over leveraging. It's a long period of time of buildup, and then when you hit the bang point, then you pay the consequence and look back and say, oh my gosh, we forgot the lessons of 50 years ago, and because that's how long that cycle is.
that's right.
And the policy
Or longer in some cases.
or longer. And so we keep repeating it. And basically, Lacy's making the point, and I think the Kindleberger, the financial instability point is that when you use leverage, and it's a lot of fun when it's building up, so you keep doing it until you reach that point.
They're beneficiaries. There are lots of beneficiaries of it. Right. And it all seems to be good.
This is, by the way, I'm reminded way back in somewhere I learned this, I think as a student, the macroeconomics at academia used to be called, before it was called macroeconomics, it was called prosperity and depression. So this is a nomination to change the name in the catalog. Back to the future. We're going. We're back here again. All right, let me throw out a few wild cards. I think it's quite clear. Anything fiscal policy buys us is short view and makes it worse. Monetary policy is a short view. It's containment that makes it ultimately worse. And they find out probably 6 months, a year later, a year and a half later. So, and they've been through the cycle a few times. So it's quite likely that we'll go back to the path. One thing I would wish
Could we talk about fiscal policy I think there is a path with fiscal policy.
I was going to get to that.
Okay.
Growth.
Okay.
All right. Here's one. Okay. This was going to be one of my questions, which is, let's handle it now. When you get a debt overload, debt relative to income, you reduce the debt, but the question is, what room do you have to increase the income flow relative to the debt? I think it's conceivable to me, and I wish you'd comment on in general, but I'm getting the sense that the U.S. is beginning to converge back to the emerging markets, that the relative wage differential and exchange rate differentials are narrowing, where our trade gaps are narrowing. And also we have the prospect of becoming energy independent. So it's conceivable to me that we, in the next 10 years, probably not viewed, as you point out in your last commentary, that what's the thrust for the economy is coming from trade. Do you see that or any other source? And I guess you might be talking about fiscal policy changes that could possibly try to increase the denominator of the debt income ratio.
Well, the best thing would be some major technological innovation or a series of dramatic technological breakthroughs, which in one fell stroke made a lot of the existing technologies inappropriate. And the technologies would be so fantastic and so strong in cash generation that we could pay off the debt. I mean, that would be the answer. Unfortunately, we don't have historical examples of that happening.
And productivity the last several years has declined.
It has declined. But I think there is a narrow path with fiscal policy. I don't believe that expanding the deficit would do any good, even if you were to do what John Kennedy did in the early 60s or Ronald Reagan did in the early 80s, where they cut the marginal tax rates, increased the deficit, and we did get a fairly strong response. The problem is that gross debt is already above 100%. And the Cicchetti work, as well as the Reinhardt and Rogoff work, show that once you get above 90% gross debt to GDP, economic activity slows. So we don't have that option, the Kennedy-Reagan option. But we've got these problems at the fiscal level. There's too much debt. We have made promises with regard to Social Security, Medicare, that we cannot keep. Barry Eichengreen, outstanding economist at the University of California, Berkeley, wrote a wonderful little book called Exorbitant Privilege. And he has calculated that without law changes, the federal budget, which is now 25% of GDP, will jump to 40% of GDP in 25 years. So we would have to try to transfer 15% of GDP from our working households to our retired households, which for Eichengreen means we're not going to be able to do it. So there will have to be law changes. So to deal with, we've got too much debt, we have made too many promises that cannot be kept. Deficit spending per se is counterproductive, but we have to have a program of shared sacrifice. We're not going to be able to do this all on the expenditure side. The problem is too large. Now, on the tax side, we have some options. Taxes are going to have to be raised. There's no question, because the problem is too severe. And to assume that we don't have to use higher taxes is incorrect. We're going to have to. But it's the issue of what type of taxes. The academic research shows that when you change the marginal tax rates, you're dealing with fire. The marginal tax rate multipliers are somewhere between -2 and -3. So you raise the marginal tax rates, you're going to really hit the economy. You change behavior. However, it appears that the responsiveness of the economy to the loopholes, or what we call the tax expenditures, is not nearly as great. If you go back to the 86 tax law, which was a revenue neutral bill, in which we brought the marginal tax rates down and we closed loopholes. 10 years later, the economy responded, and the study showed that it did. So in the concept of shared sacrifice, what I think you should do is you should try to hold the line on the marginal tax rates.
Or reduce it.
Or reduce them, preferably, and eliminate the loopholes. And for me, I would eliminate all the loopholes.
Is it tax neutral? Is it
I think
budget neutral?
I keep it in a budget neutral sense, because I think the marginal tax rates have a multiplier of at least -2, and the tax expenditure multiplier is only maybe -0.5. That's my own calculation. I've not found any work to corroborate it, but we do have the 86 experience. And then we're still left with a need for more revenue. And to my way of thinking, there's going to have to be some type of consumption-based tax. I don't think it has to be particularly high. But I would rather go toward some consumption-based tax and less of a marginal tax rate, because the evidence is that is going to help the economy. I mean, the great philosopher Thomas Hobbes said that income measures your contribution to society, and spending measures what you take from society. What we've done is we've overspent, we've not generated enough income. So what you want to try to do is to penalize the consumption and to reward the income. But of course that implies over the near term austerity. And I must tell you that this path is not going to solve the problem. And there have been some pretty thoughtful efforts that have essentially moved in this direction. I mean, I don't agree with the general thrust of most of the proposals that were in the so-called Simpson-Bowles recommendation. But it was shared sacrifice, and it tried to deal with all of these issues, and it couldn't get the required number of votes, which may mean that it's a sign that we simply don't have the political will to tackle the problem that is now so great.
But there is some possibilities there, I would think. But nonetheless, so there is a ray of hope.
There is a ray of hope. There is a path.
There is a path out there.
It's very narrow.
Right.
It's very narrow, and it would require a lot of cooperation on the political front that so far we haven't been able to show that we could do.
Right. Well, I'd like to keep the thought of there is a possible way out of here, a constructive way out, to one last overhanging threat and fear, and that is an issue that I know you've done a good bit of work and investigated, and that is the issue of China's over-indebtedness. Mm-hmm. And are they another bubble out there that is really not being properly observed on the radar screen?
Well, that's a great question, and of course it's been the most rapidly growing country in the world. It's now approaching the third. It's the third largest. It's only a matter of time before they overtake Japan. The general theory is that the Chinese have a command economy. They can engage in another massive round of deficit spending should they need it, which will not only lift them but all of Asia. I don't think that's what the Chinese data show. Now the Chinese data is hard to get at. If you look at their official government debt to GDP, it's like 16%, and we're at 100. However, they have substantial hidden liabilities that are direct obligations of the Chinese government. They have them to the banks, which they own. They have them to the some of the provinces, to the railroads, and to the airlines. McKinsey Global Institute, which has done more work on debt than anyone else, says that when you take into account the hidden liabilities, we're talking about gross debt in China of 160%, and we're at 100, which means that you're beyond the point of cutoff for both Reinhardt and Rogoff. Debt slows dramatically after gross government debt goes above 90%. Cicchetti in the 80 to 100% range. So China already is, and moreover, this Chinese debt has resulted in a lot of malinvestment and a misstructured economy. They've got 70% of GDP in investment and 30% in consumption. Mm-hmm. And a lot of this investment was, quite frankly, very unproductive. They built cities that are vacant. They built warehouses and other facilities.
Strongly suggests overcapacity.
It does, and they built railroads that are now having to be repaired. Right. The banks are now undercapitalized. Yeah. And this outstanding researcher, Carl Walter, he and Fraser Howey produced a book called Red Capitalism. Carl Walter, a Stanford PhD, lives in Beijing, speaks Mandarin, believes that China is moving toward the point that they reached in the 1990s, where the government budget will have to be redirected to bank capitalization. When this happened in the 1990s, it spawned the Asian economic crisis. In other words, you take it out of the spending stream, you put it into bank recapitalization. And if that's the case, if we're moving there, we may not be here this year or next year or the following year. But the Chinese could be a more unstable element than many presume. And frankly, I saw something in the last week that told me that we might be nearer. China ran a trade deficit for the first time in a long time. In fact, we saw both China and Japan run trade deficits, mainly because European demand has fallen away. And what is their first response? They devalue the yuan, mm-hmm. by 1.5%. So the Chinese are looking to take, in my opinion, and that's their key. They're not contributors, they're takers. And if that's the case, they're really not in a position to be a net supporter of economic activity.
Well, if you have a 70% investment share of GDP, just the maintenance of the depreciation of your capital stock puts you in big trouble.
It's huge. Yeah. There are ongoing costs there that people do not realize until you.
Ongoing costs. Well, Lacy, thank you very, very much.
My
We
pleasure.
really
Always,
appreciate it.
Lou, it's always great to be with you, and I want to say that I just think it's a tremendous job you're doing, and I hear from so many of your students, both current and past students, and congratulations to you on your outstanding job at the Macomb School.
Thank you.